Welcome to our deep dive into investing strategies. Today, we'll explore how savvy investors turn market dips into opportunities, and we'll take a closer look at SCHD, a popular dividend ETF that faced an unexpected fall in 2024. Let's get started. In the world of investing, there are few things more unnerving than watching a trusted asset fall. For the average investor, red charts trigger red flags. But for a certain kind of investor, the ones who understand history, data, and long-term value, a dip is not a warning, it's a whisper, an opportunity, a rare moment to act when others freeze. In early 2024, SCHD, the Schwab U.S. Dividend Equity ETF, began to fall. Not just slightly, but to a degree it had never fallen before. For many, it was a shock. After all, SCHD had built a reputation over more than a decade as one of the most stable and reliable dividend ETFs in the market. Since its inception in 2011, SCHD had averaged an annual return of approximately 12.5%, beating out many actively managed funds. It tracked the Dow Jones U.S. Dividend 100 Index, focusing only on companies with at least 10 years of consistent dividend payments, strong fundamentals, and high cash flow. It was known for holding blue-chip companies, names like PepsiCo, Coca-Cola, Merck, Texas Instruments, and Home Depot. The kinds of businesses you expect to be around in 10, 20, even 50 years. The market experienced a significant shift, and investors reacted swiftly. High interest rates, persistent inflation, and global tensions caused even the strongest dividend stocks to lose favor. Investors fled toward safer short-term assets like money market funds, offering yields over 5% with zero volatility. Growth stocks began to shine again, and funds like SCHD fell by over 15% year-to-date, the worst drawdown in its history. But in 2024, the market shifted. High interest rates, persistent inflation, and global tensions caused even strong dividend stocks to lose favor. Investors fled towards safer short-term assets like money market funds, offering 5% plus yields with zero volatility. Growth stocks began to shine again, and funds like SCHD fell by over 15% year-to-date, the worst drawdown in its history. Social media exploded with fear. Posts warned of dividend traps. Analysts debated whether SCHD was outdated, but one investor remained calm. Not only calm, strategic. While others panicked, he looked at the facts. SCHD's dividend yield had risen to over 4.4%, its highest level in nearly a decade. The price-to-earnings ratio of the ETF had fallen below 14, signaling that its holdings were undervalued by historical standards. The top holdings continued to show strong earnings, low debt-to-equity ratios, and increasing dividends, despite the broader market downturn. SCHD's 5-year dividend growth rate remained around 13%, proving its long-term strength. He understood something many didn't. Volatility does not mean weakness. Price action and fundamentals are not always aligned in the short term. The investor's strategy was built on a historical perspective. He knew that markets have cycles, and that patience often pays off. By focusing on fundamentals and long-term growth, he positioned himself to weather short-term volatility and benefit from eventual market recovery. So he began to buy, not recklessly but consistently. He increased his position in SCHD and doubled down on 2 other core ETFs in his portfolio. Each purchase made while others were uncertain. Each share added with the quiet confidence of someone who'd studied the past. Because this wasn't his first downturn. He remembered 2008, he remembered 2020, and he knew the truth. The stock market has never failed to recover from a correction. In fact, if you had invested in the S&P 500 during any bear market over the past 100 years and held for at least 5 years, your chances of losing money were less than 10%. In 10 years, 0. SCHD was not broken, the market was simply rotating, and those who understood that, those who didn't flinch, stood to benefit the most. The investor's philosophy and long-term vision are crucial. They guide decisions through market highs and lows, ensuring a steady path to growth. Remember, patience and strategic thinking often yield the best results. This investor had a rule: buy when it's hard, hold when it's boring, and collect when others chase. He wasn't guessing, he was using logic, data, and discipline. While some were asking, what if SCHD never recovers? He was asking, when it does, will I have enough? Because dividend investing isn't about hype. It's about ownership. It's about holding real businesses that produce cash flow. SCHD offered that. Every month, every quarter, even through the dip. And here's the best part. He didn't need it to moon. He just needed time. If SCHD simply returned to its average historical price and continued its dividend growth at 10% per year, his yield on cost would eventually surpass 6%, 7%, maybe even 8%, forever. Building wealth through patience and courage. He wasn't just buying a dip, he was building a future. So while others waited on the sidelines, trying to catch the perfect bottom or chase the next hot stock, he kept building, quietly, steadily, month after month. Because in the end, wealth isn't built in moments of certainty, it's built in moments of doubt by people who choose courage over comfort. And so he held his shares, he added more, and he smiled. Not because he knew exactly what would happen tomorrow, but because he understood what always happens over time. The markets recover, dividends grow, patience wins. He didn't fear the fall, he embraced it. And that's the kind of investor the future belongs to. If you found value in this story, hit that like button and subscribe for more real-world investing wisdom. This isn't hype, it's strategy. Let's build wealth the smart way. If you found value in this story, hit that like button and subscribe for more real-world investing wisdom. This isn't hype, it's strategy. Let's build wealth the smart way.